If you focus on getting your money to work for you, you're never going to build wealth. Hi, I'm Keith Weinhold. This is Get Rich Education. Either you can be a conformer or you can build wealth. Pick one of those two. Now, putting your money to work for you, despite being a popular piece of investing advice for generations, you're typically learning from people that never really got a financial education. Now, there are those outliers. If you're an early investor in Apple or Facebook or TikTok yourself, then congratulations, you probably did really well investing your own money, but those types of stories are exceedingly rare. People that invest in things like 401ks and IRAs, you might retire comfortably if you make a ton of sacrifices along the way and live a small life and don't go on that many vacations and put aside 10 to 15% of your savings in these vehicles, sacrificing your quality of life the entire way. But wealthy people know it's not about them only getting their own money to work for them. It is at next level. You need to employ other people's money to work for you. Now that might sound really sophisticated if you're middle class or something like that, but actually when you take out a loan for a piece of real estate that cash flows, you are ethically using other people's money three ways at the same time. In fact, the banks for the loan and the leverage, the tenants for the cash flow, which is a new income stream that you built for yourself, and the government for very generous tax incentives at scale as you grow your portfolio. You're using other people's money three ways at the same time, and it does not take you having any sort of degree or certification to do this either. A lot of people have money as equity in their own home that for some reason they regard as sacred, but I asked myself long ago, why would I have any more money than necessary tied up in my own home when I can borrow against that home at interest rates that now are even often less than inflation and tax advantaged? Now, it's sort of an irony. Real estate has made more ordinary people wealthy than anything else, but yet the return from home equity is always zero, as I've discussed elsewhere. So it's a good idea to harvest your equity prudently and disperse it into several cash flowing properties. And when you do that, you actually lower your risk as long as you chose the right market, because now you can be in multiple markets for diversification. Now, to some, it might feel safe or like the right thing to do to scrimp and save and store an awful lot of money in their home. But as soon as one makes any extra principal payment, or really any principal payment at all, even your monthly scheduled ones, here's what you're saying to the bank. Hey, Mr. Banker, here's a $1,000 extra principal payment. Don't pay me any interest on it. If I need it back, I'll pay you fees, and I'll prove to you that I qualify again. Here's a $1,000 extra principal payment. Don't pay me any interest on it. If I need it back, I'll pay you fees, and I'll prove to you that I qualify again. That doesn't make any sense, especially at today's low interest rates. It didn't make any sense decades ago when interest rates were 8%, and it even makes less sense now when interest rates are less than half that. Being an equity sitter like this, it kills your velocity of money. And those that desire to have a paid off home, they probably don't understand that the rate of return from that is always zero. And even once one does have a paid off home, meaning the mortgage principal and interest are paid off, your housing payment isn't anywhere nearly paid off. Because even in that paid off position, you're still going to owe property tax and property insurance and repairs and maintenance and utilities and HOA dues and other things. That's not the position that you want to be in, because you're not employing the use of other people's money. The banks, even in the case of a primary residence, because you have the ability to borrow against or leverage against that. So when you borrow at a lower rate, say 3 or 4% in your home, and you invest at a higher rate, say 10%, even 20% or more, that difference is called arbitrage. If you have a 12% return minus a 4% interest rate or cost of capital that you borrowed against, your arbitrage is therefore 8%. Kind of a sophisticated sounding word, but it's simple. It basically just means borrowing at a lower rate and investing at a higher rate. That's arbitrage. So being an equity sitter kills your velocity of money. Now, property flipping, meaning active involvement where you go in, buy a home for say 100K, fix it up and sell it for 200K, meaning that you had to apply the sweat equity yourself, that's taxed at a really high rate. Pretty much the highest tax rate you'll pay in all of real estate is property flipping. Flippers have spending money and they have to go in and get active and do it over and over again. But buy and hold real estate investors, they're the ones that build real wealth and don't just have spending money from each successful flip. Equity sitters get old and house flippers can get pretty tired. Owning a few paid off properties, that is a slow way to wealth. Having small equity positions in a lot of properties, that is a fast way to wealth. So rather than flipping properties, flip equity. Rather than being an equity sitter, you can be an equity flipper. Say you own a paid off $1 million apartment building even, not even your own home in this example. With a 5% appreciation rate, that yields a capital gain of $50,000, and that occurs regardless of the amount of equity that you have in the property. You want to understand that. So therefore, if you would sell that property and use the proceeds to put 25% down payments on 4 different $1 million properties, you would then have $4 million worth of property. So with a 5% appreciation gain on that, you would yield a $200,000 annual gain. How did that happen? You profited from a gain on both your money and the money borrowed from the bank. Yes, other people's money. No property renovations occurred in our example either. You did not benefit by flipping property. You benefited by flipping equity into more property. That increases your velocity of money. It increases your portfolio size. It increases your leverage. It decreases your risk because you can be in multiple markets. It increases your inflation profiting benefit because you're borrowing more of this long-term fixed interest rate debt. And it increases your tax benefits when you take a small seed, harvest it, and let it multiply into several properties. And by the way, personally, the property that I own longer than any other, I've owned it for 8 years, and it's currently for sale. That's too long because it's become too equity heavy with about 50% equity in it. So I'm losing that multiplying effect of the leverage. It is time for me to sell it, take that equity, and put a 20 to 25% down payment in a larger property to create more cash flow, leverage, and everything else I'm talking about. I'm not flipping property. I'm flipping equity. And you might be wondering, isn't this risky? In that example I gave with the several properties totaling $4 million, aren't 75% loans on $4 million properties? Doesn't that mean that I incur $3 million of debt? Well, that debt is outsourced to tenants. Again, other people's money. When I buy carefully and I buy a property where the rent income exceeds all the monthly expenses, meaning that tenant pays all the monthly mortgage principal, all the interest, and something on top of that called cash flow, that's my passive income. Now, what if the housing market endures a correction and almost all housing loses value, like what happened between 2007 and 2009? I was an investor between 2007 and 2009, and my properties were temporarily suppressed in value. But as long as I bought for cash flow, where I have a tenant that can pay that monthly payment, I don't really mind that values are temporarily suppressed because I'm being paid an income stream every month that I hold on to the property. So that's why you want to be in multiple markets. You don't want to have all your properties in one town of 8,000 people where a quarter of the town is employed at a meat packing plant or a uranium mine or something like that. That's not very stable. You want to be in a big metro that's generally growing where you have a reasonable expectation that a tenant can come in and pay the rent. In fact, when you buy a property, you don't buy it so much for the tenants that are in that property now. You buy it that there's a reasonable expectation that, say, 18 months down the road, when another tenant comes in, they would probably be able to pay the rent, meaning you're buying in a market that has population growth and job growth, and that's big and diverse enough to host a number of economic sectors. You're really getting some safety now. In fact, the market is even more important than the property when it comes to equity flipping. You want to flip into a good market. So what are your takeaways? Well, middle class people only get their money to work for them, and those that transform from middle class to wealthy ethically employ other people's money. You can do it without any particular skill set or certification or degree when you buy cash flowing real estate with a loan. Again, the three ways are you're using the bank's money for the loan, the tenant's money for the income stream, and the government's money for very generous tax incentives at scale. So don't be an equity sitter. And a lot of times you don't want to be a property flipper. Even property flippers eventually want to be equity flippers, flipping their equity into more and more cash flowing property. You can grow wealth faster by owning small equity positions in several properties. Hey, put a YouTube like on this video if you like equity flipping and like the concept of that, keeping up your velocity of money, employing other people's money prudently and not just your own. I'm Keith Weinhold. Thanks so much for stopping by.